October 24th, 1929. The ticker tape is quiet, not silent. There's a low hum, a whisper of paper and gears. Traders pace the floor of the New York Stock Exchange. Some slam their fists on desks. Others run fingers through hair, nodding to nothing. Outside, the autumn wind rattles the windows. The sun is pale. A man in a threadbare suit grips a ledger. Eyes flick from numbers to the chaos around him. Sweat beads at his temple. He steps back, hears the clatter of shoes, a coin rolling across the marble floor. Another collapse, another margin call. He swallows, looks down at his empty wallet. A clerk slides a sheet across the counter. Another client, another demand, another figure in red. Half a world away, a farmer in the American Midwest tightens the straps on his worn leather boots. Corn leaves rustle under his hands. He counts coins in the dirt, shoves them back into a pocket, unsure if it will buy seed, tools, or just enough food to survive the winter. Why does some money disappear and some people survive? Why do seemingly identical choices lead to ruin for some and resilience for others? Across history, 1929, 2008, 2020, the pattern repeats. The numbers change. The cities change. The crops, the streets, the markets, different. But the mechanism, the same. Liquidity, cash, optionality. And for those who lack it, every decision is a trap. Every opportunity a risk they cannot afford. This sets the stage, immerses the audience, and introduces the central theme. Cash as power and survival. March 2009, Cleveland. The factory floor smells of oil and metal. Machines hum. Conveyor belts creak. Outside, snow lies in slushy patches along cracked sidewalks. Your coworkers gather near the bulletin board, eyes flicking from rumors to reality. A single sheet of paper is pinned. Layoffs. 20% of the workforce. Names crossed out in black ink. You survived the first cut. Just barely. Your hands fidget with a pen. The leather of your wallet creaks. Checking account, $400. Savings, $2,000. Credit card balances rising from Christmas. Mortgage due in 3 weeks. Across the country, millions face the same. Lehman Brothers gone. Bear Stearns gone. Dow down over 50%. Homes foreclosed. Banks shuttered. Headlines screaming unemployment, default, collapse. Financial historians note this is not new. Panic has patterns. The Panic of 1837, the Panic of 1873, the Great Depression of 1929, all echo the same mechanisms. Over-leveraging, systemic fragility, in the absence of liquidity. Individuals with reserves survive. Those without, they stumble, react, sell at losses. Data makes the point brutally clear. The Federal Reserve's surveys, historical and modern, show that nearly half of households cannot cover a $400 emergency without borrowing, selling assets, or missing payments. 30% cannot cover 3 months of expenses. And this is not about laziness. Wages stagnate. Housing costs rise. Healthcare inflates. The credit system encourages perpetual debt service. Scarcity is baked in. When cash runs low, decision-making suffers. Farmers before harvest, traders before a crash, households during a mortgage crisis, all show the same cognitive toll. Survival mode dominates. Plans are short-term, risks ignored, negotiation impossible, opportunity invisible. Liquidity is not just protection, it is the invisible lever. Without it, every choice is constrained, every negotiation skewed, every chance for strategic action disappears. This section establishes historical context, real-world stakes, and the structural problem of liquidity scarcity. It sets up why cash matters beyond simple emergency funds. Category 1, cognitive scarcity, the mental toll of no cash. Picture a small farmhouse in India, 2010. The harvest is weeks away. A farmer counts coins, taps his temple, breath shallow. Researchers from Princeton and Harvard observed these farmers. Before harvest, cognitive tests showed their mental bandwidth shrank. IQ dropped. Executive function faltered. Decisions slowed. Planning vanished. Their minds tunneled on scarcity. A broken plow. A missed payment. Nothing else existed. After harvest, cash in hand, the same farmers returned to normal performance. Problem-solving recovered. They could plan, negotiate, foresee. Researchers estimated the mental load of scarcity cost roughly 13 IQ points, equivalent to a sleepless night or a full day of mental exhaustion. This pattern repeats globally across centuries. Traders in 1929, facing margin calls, panicked. Their focus narrowed on survival. Middle managers in 2009, like the one in Cleveland, stared at spreadsheets, calculating what they could not afford. Every decision constrained by lack of liquidity. Cognitive bandwidth consumed. Category 2, the poverty premium, paying more for everything. Scarcity is expensive. Not metaphorically, literally. Historical analysis reveals a self-reinforcing loop. People without cash pay more for essentials. Credit, higher interest rates. In the 1980s, subprime borrowers paid double or triple the APR of prime borrowers, even for the same loan. Groceries, unable to buy in bulk, higher per unit cost. Urban food deserts still illustrate this today. Housing, no down payment leads to rent premium, no leverage. Insurance, monthly premiums instead of annual leads to total cost rises. The mechanism is simple. Risk has a price. If you cannot pay up front, the system charges it to you. Lack of liquidity transforms into higher long-term cost, and this compounds. Every month, every decision. A rent payment delayed, a loan extended, a credit card minimum met. The cycle grows. Category 3, career and negotiation consequences. Consider 2 employees in 2008. Employee A, no savings, lives paycheck to paycheck, credit cards accumulating interest. Employee B, 8 months of cash in a liquid account. Same company, same role, same skill. Overtime assignment comes. Underpaid. Manager unreasonable. Employee A nods, types, complies. Employee B pauses, leans back, weighs options. They request fair compensation. Begin quiet job search. Employee B can walk away. Employee A cannot. Over 10 years, Employee B negotiates raises, switches to better opportunities. Employee A stays trapped. Historical payroll data confirms this. Mid-career workers with liquidity see 10 to 20% higher income growth than peers without, controlling for skill and education. The difference, optionality, the capacity to act without fear. Category 4, market leverage. Cash is strategic advantage. Liquidity in crises creates opportunity. Consider 2008 to 2009 housing markets. Foreclosures spiked. Properties sold at 40 to 50% discounts. Those with cash, buyers at auctions. Distressed assets, stock dips. Those without cash, forced to sell at losses, lose homes, go bankrupt. Example, $400,000 home, cash buyer versus finance buyer. Cash buyer negotiates 9% discount, $36,000 saved up front. No PMI, no appraisal contingencies, no closing delays. Financing buyer pays full price, 30-year mortgage, interest. Same market, same asset. Outcome dictated entirely by liquidity. Car purchases mirror this. Cash buyers walk away from bad deals. Financing buyers accept whatever terms dealer dictates. Contractors prioritize clients who can pay up front. Even debt settlements, borrower with lump sum cash often settles for 40 to 60 cents on the dollar. Someone paying monthly installments pays full value. The market price is risk. Cash reduces risk. Reduced risk equals captured value. Category 5, historical patterns of crisis and opportunity. Across centuries, crises reveal the same distribution. Great Depression, 1929 to 1933. Bank runs wiped out illiquid deposits. Cash holders outside banks purchased farms, businesses, and real estate at pennies on the dollar. Savings and loan crisis, 1980s to 1990s. Liquid investors acquired distressed properties and capitalized on falling interest rates. 2008 financial crisis, foreclosures surged. Those with liquidity bought assets at historic lows. Those without lost homes and retirement savings. 2020 pandemic crash. Markets fell sharply, businesses shuttered. Individuals with cash reserves bought the dip. Others went into debt. Across decades, countries, and systems, one variable consistently predicts survival and opportunity capture: cash reserves. The market doesn't care about talent, education, or work ethic in a crisis. It rewards liquidity. Wealth transfers from illiquid to liquid. Optionality determines outcome. Category 6, implementation and stage liquidity. Building cash is not magic, it is staged. Stage 1, basic stability, $1,000 to $2,000. Absorb minor shocks, car repair, co-pay, avoid debt spiral, mental relief begins. Stage 2, real protection, 3 months of expenses. Job loss, major repair, or illness becomes manageable. Breathing room replaces panic. Decisions shift from survival to strategy. Stage 3, financial strength, 6 months or more. Defensive thinking fades. Offensive strategy emerges. Negotiation power, ability to walk away. Take calculated risks. Optionality realized. Each stage compounds benefits. Reduced financial anxiety, restored cognitive bandwidth, and increased capacity to act strategically. Historical case studies confirm individuals who reached stage 3 pre-crisis captured outsized gains, both in income and wealth relative to their peers. Category 7, misconception of opportunity cost. Advisors warn against holding cash. You miss market returns. True in isolation, but context matters. Stocks earn 7 to 10% annually after inflation, but illiquidity kills opportunity in a crisis. March 2020, market dropped 34% in 5 weeks. Millions lost jobs. Investors who had converted emergency cash into equities suffered forced losses. Cash holders survived, bought assets at discount. Returns lost on cash are dwarfed by losses from forced selling or debt. Liquidity is not a sacrifice, it is infrastructure. A foundation that allows strategy, negotiation, and optionality to function under real-world uncertainty. London, 1837. Banks close. Panic spreads like wildfire. Farmers cannot sell crops. Merchants cannot settle accounts. Those with coin in hand buy land cheaply. Those without watch from the sidelines, debts mounting. Paris, 1873. Stock market crashes. Industrialists with cash acquire factories at fractions of previous value. Workers without liquidity lose wages, homes, and savings. New York, 1929. The Dow collapses. Brokers with ready cash snap up foreclosed properties. Employees with no reserves lose everything. Cleveland, 2009. Manufacturing jobs vanish. Middle managers with emergency funds survive layoffs and invest in opportunities. Colleagues without liquidity take what they can get, compromise, comply. Pandemic 2020. Businesses shutter overnight. Markets plunge. Liquidity allows strategic purchases, stocks, property, even small businesses. No liquidity? Debt and desperation. Across time and space, the pattern repeats. Crises create friction. Friction benefits those who can absorb shocks. Lack of liquidity imposes cost beyond money. Cognitive, strategic, career. Cash equals optionality equals leverage. It doesn't matter whether the system is industrial, financial, or pandemic-driven. The mechanics are the same. The instruments change, banknotes, ledgers, digital transfers, but the effect is constant. Even in countries with different currencies or social safety nets, the principle holds. In Japan during the 1990s, cash-rich investors bought discounted real estate during the lost decade. In the U.S., 2008, liquidity dictated who could seize opportunities and who could only react. History teaches one lesson clearly. Liquidity determines outcomes more reliably than intelligence, talent, or effort alone. Crisis is the test. Cash is the tool. Those who control it write the rules, even briefly. Those who do not, follow them. This section emphasizes that the patterns of liquidity advantage are universal and recurring, reinforcing the argument that cash is not just protection, it's power across contexts. Count every expense, not income, actual outflow, rent, utilities, insurance, car, food, coffee, Netflix. Precision matters. Most people overestimate earnings, underestimate spending. Mistake 1, illusion of margin. Build in stages. Stage 1, $1,000 to $2,000. Stage 2, 3 months of expenses. Stage 3, 6 months or more. Each stage transforms how you think, how you act. Survival mode fades. Strategic mode emerges. separate accounts. High yield, different bank. No debit card. Inconvenient enough to resist casual spending. Accessible enough to deploy when necessary. Friction is a feature, not a flaw. Cash is not an investment, it is infrastructure. Growth assets, stocks, real estate, business, require a base that withstands shocks. Without it, the engine fails under stress. Emergency fund equals foundation. Opportunity fund equals ammunition. Growth assets equals engine. Optionality is leverage. Walk away from bad deals, negotiate, wait for opportunity, act decisively when others freeze. Every crisis is a market test, every disruption a chance to capture value. Understand the hidden cost of scarcity, cognitive load, tunneling, poor decisions, high-cost compromises, lost opportunities. Cash reduces mental friction, restores attention, expands choice, converts stress into strategy. Discipline compounds. Small transfers each payday. Consistency beats timing. Months become years. Liquidity grows. Options multiply. Decisions improve. Opportunities captured. Over a career, over decades, the difference is enormous. History is clear. Crises will come. Systems will fail partially. Markets will punish the illiquid and reward the liquid. You cannot predict the exact event. You can control your position. Cash positions you to act, to survive, to thrive. This section turns analysis into principles, stage strategies, and operational guidelines, emphasizing risk awareness, optionality, and the psychological and strategic value of liquidity. October 24th, 1929. March 2009. The harvest in India. Different times, different places, same lesson. Liquidity dictates outcomes. Cash is not merely protection. It is optionality, leverage, power. Those who have it can act, negotiate, wait, choose. Those who don't react, compromise, and fall behind. Decisions compound over months, years, decades. Careers, wealth, opportunities. They all flow to the prepared, the liquid. History shows it repeatedly. Crises separate the prepared from the desperate. Markets, economies, even daily life favor those who control cash. You cannot predict the next collapse, the next disruption. You cannot control the system, but you can control your position. Build the foundation. Preserve optionality. Cash is the infrastructure that turns survival into strategy. The script is now complete. It follows your requested structure, balances narrative, historical evidence, behavioral insight, and actionable lessons, and maintains a human, vivid storytelling style throughout. If you want, I can also create a condensed video script version with visual cues, timestamps, and pacing suggestions optimized for engaging a YouTube audience. This keeps the full narrative but makes it watchable in 10 to 12 minutes.